School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Block 3 Application of Cost Accounting, Unit 10 Budgeting and Budgetary Control, Part 2.
Control ratios. The budget is a part of the planning process. After the various budgets, including the master budget, have been prepared, you may like to compare actual performance with the budgeted performance. This can be done by using three important ratios. These ratios are activity ratio, capacity ratio, and efficiency ratio. These ratios are expressed in terms of percentages. If the ratio works out to 100% or more, the trend is taken as favorable. If the ratio is less than 100%, the indication is taken as unfavorable. Let's discuss these ratios in detail. Activity ratio. Activity ratio is a measure of the level of activity attained over a period of time. It is obtained by expressing the number of standard hours equivalent to the work produced as a percentage of the budgeted hours. The equation is activity ratio equals to standard hours for actual production divided by budgeted hours into 100. Capacity ratio. This ratio indicates whether and to what extent budgeted hours of activity are actually utilized. It shows the relationship between the actual number of working hours and the maximum possible number of working hours in a budgeted period. The equation goes as capacity ratio equals to actual hours worked divided by budgeted hours into 100. Efficiency ratio. This ratio indicates the degree of efficiency attained in production. It is obtained by expressing the standard hours equivalent to the work produced as a percentage of the actual hours spent in producing that work. So the equation goes as efficiency ratio equals to standard hours for actual production divided by actual hours worked into 100. Performance budgeting. As explained in the preceding sections, budgeting is nothing but the technique of expressing, largely in financial terms, the management's plans for operating and financing the enterprise during specific periods of time. Any system of budgeting must provide for performance appraisal as well as follow-up measures in order to be successful. The traditional, also known as line item or object account budget in government, enumerates estimated expenditures by type and quantity for a specified period of time, usually 1 year. The expenditure is classified by the object, the personnel are listed by type of position, the budget is divided into sections according to organizational units, departments, sections, and the types of expenditure are listed by category. The primary purpose of traditional budget, particularly in government administration, is to ensure financial control and meet the requirements of legal accountability, that is, to ensure that appropriation, sanction, or allotment limits for different items are not related to the intended or planned outputs or achievements. The necessity for linking the expenditures or inputs in financial terms to outputs in physical terms, facilitating the evaluation of outcomes or result of activities, cannot be overemphasized. Performance budgeting or program budgeting has been designed to correct the shortcomings of traditional budgeting by emphasizing management's considerations or approaches. Both the financial and physical aspects are incorporated into the budget. A performance budget presents the operations of an organization in terms of functions, programs, activities, and projects. In performance budgeting, precise attainment of job to be performed or services to be rendered is done. Secondly, the budget is prepared in terms of functional categories and their subdivision into programs, activities, and projects. Thirdly, The budget becomes a comprehensive document. Since the financial and physical results are interwoven, it facilitates management control. The main objectives of performance budgeting are: number 1, to coordinate the physical and financial aspects; number 2, to improve the budget formulation, review, and decision making at all levels of management; number 3, to facilitate better appreciation and review by controlling authorities like legislature, board of trustees or governors, etc., as the presentation is more purposeful and intelligible; number 4, to make more effective performance audit possible; and number 5, to measure progress towards long-term objectives which are envisaged in a development plan. Performance budgeting involves the evaluation of the performance of the organization in the context of both specific as well as overall objectives of the organization. It presupposes a crystal clear perception of organizational objectives in general and short-term business objectives as stipulated in the budget, in particular by each employee of the organization, irrespective of his level. It thus provides a definite direction to each employee and also a control mechanism to higher management. Performance budgeting requires the preparation of periodic performance reports. Such reports compare budget and actual data and show variances. Their preparation is greatly facilitated if the authority and responsibility for the incurrence of each cost element is clearly defined within the firm's organizational structure. In addition, the accounting system should be sufficiently detailed and coordinated to provide necessary data for reports designed for the particular use of the individuals or cost centers having primary responsibility for a specific cost. The responsibility for preparing the performance budget of each department lies on the respective department head. Each department head will be supplied with a copy of the section of the master budget appropriate to his sphere. For example, the chief buyer will be supplied with a copy of the materials purchase budget to arrange forth purchase of necessary materials. Periodic reports from various sections of a department will be received by the departmental head that will submit a summary report about his department to the budget committee. The report may be daily, weekly, or monthly, depending upon the size of the business and the budget period. These reports will be in the form of comparison of budgeted and actual figures, both periodic and cumulative. The purpose of preparing these reports is to promptly inform about the deviations in actual and budgeted activity to the person who has the necessary authority and responsibility to take necessary action to correct the deviations from the budget. Zero-based budgeting. Earlier, we have explained the formulation of different types of budgets. Suppose the approach adopted in the formulation and preparation of budgets is based on current level of operations or activities, including current level of expenditure and revenue. In that case, such budgeting is known as traditional budgeting. This type of budgeting process generally assumes that the allocation of financial resources in the past was correct and will continue to hold good for the future. In most cases, an addition is made to the current figures of cost to allow for expected or even unexpected increases. Consequently, the budget generally takes an upward direction year after year in spite of generally declining efficiency. Such a system of budgeting cannot be expected to promote operational efficiency. It may, on the other hand, create several problems for top management. Some of these problems are: number 1, programs and activities involving wasteful expenditure are not identified, resulting in avoidable financial and other cost. Number 2, inefficiencies of a prior year are carried forward in determining subsequent years' levels of performance. Number 3, managers are not encouraged to identify and evaluate alternative means of accomplishing the same objective. Number 4. Decision making is irrational in the absence of rigorous analysis of all proposed costs and benefits. And number 5. Managers tend to inflate their budget request, resulting in more demand for funds than their availability. This results in recycling the entire budgeting process. Thus, the traditional budgeting technique may be quite meaningless in the present context when management must review or reevaluate every task to utilize the scarce resources in a better manner or improve performance. The technique of zero-based budgeting provides a solution for overcoming the limitations of traditional budgeting by enabling top management to focus on priorities, key areas, and alternatives of action throughout the organization. The technique of zero-based budgeting suggests that an organization should not only make decisions about the proposed new programs, but should also review the appropriateness of the existing programs from time to time. Such a review should particularly be done of such responsibility centers where there are a relatively high proportion of discretionary cost. Costs of this type depend on the discretion or policies of the responsibility center or top managers. These costs have no direct relation to the volume of activity. Hence, management discretion typically determines the amount budgeted. Some examples are expenditure on research and development, personal administration, legal advisory services, etc. Zero-based budgeting, as the term suggests, examines or reviews a program or function or responsibility from scratch. The reviewer proceeds on the assumption that nothing is to be allowed. Therefore, the manager proposing the activity has to justify that the activity is essential and the various amounts asked for are reasonable considering the outputs or results or volume of activity envisaged. No activity or expense is allowed simply because it was being allowed or done in the past. Thus, according to this technique, each new or existing program must be justified in its entirety each time a new budget is formulated. It involves, number 1, dealing with particularly all elements of manager's budget request. Number 2, critical examination of ongoing activities along with the newly proposed activities. And number 3, providing each manager a range of choices in settling priorities in respect of different activities and in allocating resources. Process of zero-based budgeting. The steps involved in zero-based budgeting are determining the objectives of budgeting. The objective may be to effect cost reduction in staff overheads, or it may be to drop, after careful analysis, projects which do not fit into the achievement of the organization's objectives, etc. Deciding on scope of application. The extent to which zero-based budgeting must be introduced has to be decided. That is, whether it will be introduced in all areas of the organization's activities or only in a few selected areas on a trial basis. Developing decision units. Decision units for which cost-benefit analysis is proposed have to be developed so as to arrive at decisions whether they should be allowed to continue or to be dropped. Each decision unit, as far as possible, should be independent of other units so that it can be dropped if the cost analysis proves to be unfavorable for it. Developing decision packages. A decision package for each unit should be developed. While developing a decision package, answers to certain questions would be desirable. They are, number 1, is it necessary to perform a particular activity at all? If the answer is a negative, there is no need to proceed further. Number 2, how much has been the actual cost of the activity and what has been the actual benefit of both tangible as well as intangible forms? Number 3, what should be the estimated cost of the level of activity and the estimated benefit from such activity? And number 4, should the activity be performed in the way it is being performed and what should be the cost? Also, if the project or activity is dropped, can the unit be replaced by an outside agency? Financial and investment analysis. After completing decision packages for each unit, the units are ranked according to the findings of cost-benefit analysis. Essential projects are identified and given the highest ranks. The last stage is that of implementing the decision taken in the light of the study made. It involves the selection and acceptance of those projects that have a positive cost-benefit analysis or are capable of meeting the organization's objectives. This analysis shows that zero-based budgeting is in a way an extension of the method of cost-benefit analysis to the area of corporate budgeting. Advantages of zero-based budgeting. Let us summarize the advantages of zero-based budgeting as: Number 1. It provides the organization with a systematic way to evaluate different operations and programs undertaken. It enables management to allocate resources according to the priority of the programs. Number 2. It ensures that every program undertaken by managers is essential for the organization and is being performed in the best possible way. Number 3. It enables the management to approve departmental budgets based on cost-benefit analysis. No arbitrary cuts or increase in budget estimates are made. Number 4. It links budgets with corporate objectives. Nothing will be allowed simply because it was being done in the past. An activity may be shelved if it does not help in achieving the goals of the enterprise. Number 4. It helps identify areas of wasteful expenditure, and if desired, it can also be used to suggest alternative courses of action. And number 6. It facilitates the introduction and implementation of the system of management by objectives. Thus, it can be used not only for the fulfillment of the objectives of traditional budgeting, but also for a variety of other purposes. It is contended that zero-based budgeting is time-consuming. Of course, it is true, but it happens only in the initial stages when decision units have to be identified and decision packages have to be developed or completed. Once this is done and the methodology is clear, zero-based budgeting is likely to take less time than traditional budgeting. In any case, until the organization is properly acclimatized to the technique of zero-based budgeting, it may be done so that all responsibility centers are covered at least once in 3 or 4 years. Zero-based budgeting as a concept has become quite popular these days. The technique was first used by the U.S. Department of Agriculture in 1962. Texas Instruments, a multinational company, pioneered its use in the private sector. Today, a number of major companies such as Xerox, BASF, International Harvester, and Easter Airlines in the United States are using the system. Some departments of the Government of India have recently introduced zero-based budgeting intended to make the system of budgetary control more effective. Now let's summarize the unit. Financial planning is of utmost significance to management since finance is regarded as the lifeblood of business. A budget is a quantitative expression, usually in financial terms, of the future plans of an organization. It includes projections regarding the levels of activity, expenses, and revenues. A budget is an essential tool of financial planning. It helps in uncovering inefficiencies in operations, in minimizing wasteful expenditure, and in bringing out weaknesses in the organization structure. The responsibility for preparing the budget rests on the budget controller, who is assisted in his work by a budget committee. The budget committee may consist of heads of various departments with sales, production, personnel, purchase, and finance, etc. Each head of the department is made responsible for preparing and executing the budget of his department. In a business organization, the preparation of any budget is preceded by a sales forecast. A production budget is prepared after considering the forecast embodied in the sales budget and the available productive capacity, etc. The production budget includes the preparation of various cost budgets associated with the production process. Budgets pertaining to different functions or units are then combined and coordinated into one master budget. The budget may be revised from time to time if the changed conditions or the new developments so warrant. A budget may be fixed or flexible. A fixed budget is based on fixed volume of activity. If actual capacity utilization is likely to vary from period to period, flexible budgets are more desirable. A flexible budget is thus prepared for changing levels of activity. It considers fixed and variable costs separately and is therefore more useful to a business where the level of activity cannot be exactly predicted. In a budgetary control system, control ratios may be computed and used to compare the actual performance with the budgeted performance. These ratios are activity ratio, capacity ratio, and efficiency ratio. In case the ratio is 100% or more, it is considered favorable. If it is less than 100%, it is taken as unfavorable. The traditional budgeting technique takes the current level of operations as the basis for estimating the future level of operations, slowly going out of date. It is increasingly realized that the traditional technique has serious shortcomings in view of the constantly changing conditions of today. The management is expected to review and re-evaluate the task because of the increasing pressures of the environment. The concept of zero-based budgeting is considered a suitable alternative to replacing the traditional method. Zero-based budgeting techniques suggest that an organization should not only make decisions about the proposed new programs, but should also, from time to time, review the appropriateness of the existing programs. Nothing is allowed simply because it was being allowed in the past. Each program, whether new or existing, has to be justified in its entirety each time a new budget is formulated. The concept of zero-based budgeting has been accepted for adoption in the departments of the central government and some state governments.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.